The digital glow of the stock ticker radiates a vibrant neon green as the S&P 500 reaches yet another unprecedented milestone in the spring of 2026. For many onlookers, this sight does not inspire confidence, but rather a paralyzing sense of vertigo similar to standing on the edge of a skyscraper with no safety railing. You watch the numbers climb and feel a tightening in your chest because the prevailing wisdom has always whispered that what goes up must eventually come down with devastating force. This psychological friction creates a profound beitak, where the fear of losing what you have outweighs the logical potential for future growth. Most retail investors are currently trapped in a historical illusion that views all-time highs as a flashing red signal to exit the market immediately. They often mistakenly believe that the peak of a mountain is the most dangerous place to stand while overlooking the fact that the most successful companies in American history have spent the majority of their existence trading near record valuation. Data from the Federal Reserve and historical performance charts of the S&P 500 demonstrate that markets hitting new records are actually more likely to continue their upward trajectory than to suffer a sudden and total collapse. The collective obsession with finding the perfect bottom often leads to a much more expensive mistake known as the cost of missed opportunities. The human brain is biologically hardwired to identify patterns of danger which served our ancestors well when escaping predators, but serves us poorly when navigating the sophisticated machinery of the modern financial system. We perceive a record high as an unstable equilibrium because our primitive instincts cannot comprehend the massive underlying shifts in corporate productivity and technological acceleration that justify these new price levels. When you see the market soaring today, your mind screams that it is a sugar-coated mousetrap designed to snap shut the moment you commit your hard-earned capital. This internal conflict is not a sign of your weakness, but a byproduct of an evolutionary gap between survival instincts and wealth accumulation. Who truly benefits when you stay on the sidelines trembling at the sight of a new record, while the largest institutional players quietly accumulate more shares? The reality is that the financial industry often thrives on the volatility of your emotions and the frequent trading that results from your uncertainty and fear. In this video, we will dismantle the myth of the peak and explore why the very thing that makes you feel most vulnerable is actually the structural foundation of long-term prosperity. We are about to open the door to a new understanding of market mechanics that will transform your anxiety into a calculated strategic advantage for the years ahead. Why is it that the very condition you perceive as a sign of an impending crash is actually the most reliable indicator of a healthy and expanding economic engine? To understand the answer, we must look past the surface level of the stock charts and dive deep into the invisible forces that are currently powering this relentless bull market. In the next chapter, we will uncover the hidden mechanisms and psychological triggers that are quietly dictating the movement of every dollar in your portfolio right now. The Federal Reserve of the United States acts as the supreme architect of the global financial ecosystem by regulating the flow of liquidity through interest rate adjustments and balance sheet management. In the year 2026, the stability of these monetary policies has served as a high-octane fuel for the stock market, allowing corporations to borrow and expand with unprecedented precision and confidence. When the central bank chooses to maintain a supportive stance, it essentially signals to the entire world that the downside risks are being managed by the most powerful financial institution on the planet. This systemic environment creates a tide that lifts all boats regardless of individual effort or willpower, making it nearly impossible for traditional bears to find a foothold in the rising current of capital. Beyond the marble halls of the central bank, a more tangible transformation is occurring within the very fabric of American industry through the widespread implementation of advanced artificial intelligence and automation. Reports from leading financial institutions such as Goldman Sachs and Fidelity indicate that the massive capital expenditures in AI infrastructure during the previous years are finally translating into significant gains in labor, productivity, and corporate profit margins. These are not merely speculative bubbles driven by empty promises, but are instead the measurable results of a technological revolution that allows the largest S&P 500 companies to scale their operations without a linear increase in costs. This structural shift provides a fundamental justification for why price-to-earnings ratios remain elevated compared to historical averages, because the earning potential of these digital-first companies has entered a new dimension of global scalability and efficiency. This mechanical efficiency triggers a psychological phenomenon known as the wealth effect, which fundamentally alters how millions of Americans perceive their personal financial security and spending habits. As brokerage accounts and retirement funds swell in value due to the relentless climb of the Nasdaq and the Dow, individuals experience a heightened sense of confidence that encourages them to participate more actively in the broader economy through increased consumption and investment. This creates a powerful feedback loop where rising asset prices lead to higher corporate revenues, which in turn drives stock prices even higher as the cycle reinforces itself through consumer optimism. This is the invisible engine that turns the wheels of the bull market, often making the average observer feel as though they are witnessing a miraculous ascent rather than a logical sequence of economic cause and effect, driven by the expansion of the American economy. However, we must also recognize the darker side of this momentum, which involves the sophisticated gamification of finance and the exploitation of the human dopamine system by modern trading platforms and social media influencers. These digital interfaces are meticulously designed to trigger the same neurological responses as a casino floor by using flashing lights and instant notifications to keep investors in a constant state of hyper-reactivity to every minor price move. This systemic design often traps the unwary in a cycle of impulsive decisions and emotional turmoil that drains their capital through excessive fees and poor timing while lining the pockets of the platforms themselves. Instead of blaming your lack of discipline for your financial anxiety, you must understand that you are navigating a landscape specifically engineered by billion-dollar algorithms to hijack your biological reward centers and cloud your long-term judgment. By identifying these invisible engines, you can begin to distance yourself from the emotional noise of the crowd and start viewing the market through the lens of a professional strategist rather than a victim of circumstance. Understanding that the current record highs are supported by a complex tapestry of monetary policy, technological breakthroughs, and psychological feedback loops allows you to navigate the volatility with a sense of calm and objective clarity. The question then becomes how to quantify these forces and turn them into a predictable formula for your own personal growth and financial independence during this period of historic expansion. In the following chapter, we will break down the precise mathematical mechanics that allow successful investors to harness this momentum and build generational wealth, while others are left behind by their own hesitation. The concept of momentum in financial physics is often misunderstood by the average investor who views a record high as a structural ceiling rather than a foundational floor for future growth. In reality, the stock market exhibits a property known as price persistence, where assets that have been performing well tend to continue their upward trajectory due to the influx of institutional capital and the self-fulfilling nature of technical breakouts. When the S&P 500 crosses a psychological threshold, it triggers a cascade of automated buying programs and tactical reallocations from major hedge funds that provide a fresh layer of support for the next leg of the journey. This is not a speculative anomaly, but a documented mathematical tendency that has been observed across decades of market cycles in the United States and other developed economies. Consider the high cost of waiting for a market correction, which is a strategy that sounds prudent in theory but often results in catastrophic underperformance in actual practice. If an investor decides to sit on the sidelines with cash while waiting for a 10% dip, they often find themselves watching the market rise by 20 or 30% before that minor correction finally occurs. The math is unforgiving because even if the correction happens, the investor is eventually buying at a price significantly higher than the initial record high they were originally afraid of. This phenomenon is known as the drag of cash on a portfolio, and it represents the invisible fee that fear charges for the false sense of security it provides to the hesitant participant who values comfort over compound growth. The power of compounding operates independently of the nominal price of an index because wealth is built on the percentage of growth relative to the total capital deployed in the market. Whether the S&P 500 is trading at 3,000 or 6,000 points, a 10% annual return on a $100,000 investment still results in a $10,000 increase in your net worth, regardless of how high the chart looks on your screen, where the initial price of the asset is far less critical than the rate of return and the duration of time the capital remains invested. By focusing on the absolute price rather than the relative growth potential, you are essentially falling for a visual trick that ignores the fundamental mechanics of how capital expands over the long term through reinvested dividends and capital appreciation. Quantitative research from organizations like Vanguard and S&P Global consistently demonstrates that investing at all-time highs is not a recipe for disaster, as the common popular narrative suggests. Historical data indicates that the average 12-month return following a record high is remarkably similar and sometimes even superior to the average return during any other random period of market history. In fact, many of the strongest bull markets in history were characterized by a series of consecutive record highs that lasted for months or even years without a significant or lasting reversal. This evidence proves that the peak is often just a temporary milestone on an ongoing path of economic expansion fueled by corporate innovation and the increasing efficiency of global trade. Understanding these mechanics allows you to transition from a gambler who tries to predict the future to an engineer who builds a system designed to capture the inevitable growth of the economy. The math clearly shows that the greatest risk you face is not a market crash, but the persistent erosion of your purchasing power by staying out of the market for too long while the engines of capitalism continue to roar. This realization forces us to confront a deeper psychological shift that is required to move from the mindset of a frightened observer to that of a confident architect of wealth. If the numbers prove that the heights are not inherently dangerous, then why do we still feel so much anxiety when we see the market reaching for the clouds? In the next chapter, we will explore the fundamental mindset shift that separates those who merely survive the market from those who master it to buy back their most precious asset. What is the true difference in the way the wealthy and the middle class perceive a market at its absolute peak? For the average person, a record-breaking stock market feels like a fragile glass floor that could shatter at any moment, leaving them in a free fall toward financial ruin. This perspective is rooted in a scarcity mindset which treats money as a finite pile of sand that must be protected at all costs rather than a living seed that must be planted to survive. When you view the world through this lens of limitation, every upward move in the S&P 500 feels like an increasing burden of risk instead of an expansion of your personal economic territory. This emotional weight is what prevents most people from ever achieving true financial independence because they are too busy guarding their small piles of sand to notice the vast desert of opportunity shifting around them in the modern desert, digital age. The most dangerous intellectual trap for an investor during a bull market is the obsession with mean reversion, which is the belief that every price must eventually return to a historical average. While this concept holds true in simple physics, it often fails in the realm of human progress and technological evolution, where the new average is fundamentally higher than the old one. If you had waited for the market to return to its 1990s levels during the internet boom, or its 2010s levels during the cloud computing revolution, you would have spent decades watching the greatest wealth creation event in history from the sidelines. The architect of wealth understands that we are not living in a static system, but in a dynamic escalator of value, where innovation and productivity are constantly rewriting the rules of what is possible. By clinging to the price levels of the past, you are essentially trying to navigate a modern metropolis using a map from the 19th century, which only serves to keep you lost and frustrated, while others move forward with confidence. True wealth is not measured by the flickering digits on a computer screen, but by the amount of personal freedom and time you can buy back from the world. When the market reaches a new all-time high, the strategic investor does not see an expensive price tag, but rather a more powerful engine that can accelerate their journey toward total autonomy. They understand that a decision to stay invested is not a gamble on tomorrow's price action, but a calculated purchase of future options. Instead of worrying about a temporary 10% drop, they focus on the catastrophic cost of being out of the market during the next 50% gain. This shift in perspective transforms the market from a scary casino into a sophisticated money printing machine that works for you while you sleep, eat, and spend time with your family. By redefining success as the acquisition of time rather than the accumulation of currency, the fear of market heights naturally dissolves into a sense of purposeful, long-term planning. The architect of wealth also recognizes that the true enemy is not market volatility, but the silent and relentless erosion of purchasing power caused by inflation and monetary expansion. In a world where the money supply is constantly increasing, holding excessive amounts of cash is like trying to store water in a bucket with a hole in the bottom. The rising stock market is often just a reflection of the fact that hard assets and equity in great companies are the only effective shields against the devaluing nature of fiat currency. When you see the Nasdaq or the Dow Jones hitting record levels, you are witnessing the collective flight of global capital into the safest and most productive harbors available. To survive this environment, you must stop thinking like a consumer who is afraid of rising prices and start thinking like an owner who benefits from the increased valuation of the world's most essential services and products. This fundamental mindset shift allows you to look at the horizon instead of the ground beneath your feet, giving you the balance necessary to stand on the highest peaks without feeling the urge to jump. You begin to realize that the most successful individuals in the history of the United States were those who had the courage to remain optimistic when the crowd was paralyzed by cynicism and doubt. They did not achieve greatness by timing the market perfectly, but by spending the most time in the market and allowing the natural laws of compounding to do the heavy lifting for them. Now that you have mastered the psychological and mathematical foundations of this record-breaking market, you are ready to move from theory into practice. The question is no longer whether you should participate, but how you can execute a flawless strategy that protects your gains while continuing to capture the growth of the future. In the next chapter, we will outline the 3 precise, actionable steps you must take the moment you finish this video to secure your place among the architects of the new economy. Transitioning from theoretical understanding to practical execution requires a definitive departure from the chaotic attempts to time the market perfectly every single day based on headlines or social media rumors. The first and most essential step you must take right now is the absolute automation of your investment contributions through a process known as dollar cost averaging. By setting up a recurring transfer from your primary bank account to your brokerage platform on a fixed monthly schedule, you effectively bypass the emotional centers of your brain that are currently screaming about the market being too high or too volatile. This mechanical approach ensures that you are buying fewer shares when prices are elevated and more shares when the market eventually experiences a healthy correction, which mathematically lowers your average cost basis over the long haul regardless of the daily fluctuations you see on the news. Once your automation is in place, you must implement a disciplined rebalancing strategy to ensure that your portfolio does not become dangerously overweighted in the high-flying technology sectors that have led this recent surge toward record highs. Financial giants like Vanguard and Fidelity often suggest a quarterly or semi-annual review where you sell a portion of your best-performing assets to purchase more of the undervalued sectors such as bonds or international equities. This might feel counterintuitive because you are essentially selling your winners to buy your laggards, but it is the only proven method to maintain your desired risk profile and lock in profits during a period of extreme market euphoria. By acting like a cold and calculating fund manager rather than a passionate spectator, you protect your capital from the inevitable volatility that follows every significant period of expansion in the American economy. The final actionable step involves the rigorous optimization of your tax liability and investment fees by utilizing tax-advantaged accounts such as an IRA or a 401k plan as recognized by the Internal Revenue Service of the United States. Many investors lose a significant percentage of their long-term compounding potential to unnecessary capital gains taxes and high expense ratios charged by actively managed funds that rarely outperform the broader market over a 10-year horizon. You should immediately audit your current holdings to ensure you are utilizing low-cost index funds that capture the full breadth of the S&P 500 or the total stock market while keeping more of your profits where they belong, in your own pocket. This technical housekeeping is often the most overlooked part of wealth management, but it represents the structural integrity of your financial house and determines whether you will retire with a modest sum or a substantial fortune that provides true generational security in a world where every percentage point of cost matters deeply to your final result. These three steps provide the practical bridge between the psychological insights we have discussed and the tangible reality of your growing bank balance in this record-breaking era of American finance. However, even the most perfect strategy can be derailed by a few common but deadly traps that wait for investors at the very moment they feel most successful and invincible. You must remain vigilant against the seductive pull of your own greed and the quiet creep of your living expenses that can erase years of disciplined progress in a matter of months. In our final chapter, we will discuss how to safeguard your harvest from the ultimate trap of success and ensure that your journey to the top is not just a temporary visit, but a permanent change in your life. As we stand atop this financial mountain, the vertigo we first encountered in the beginning of our journey often transforms into a much more dangerous state of mind known as investor arrogance or the illusion of invincibility. It is easy to feel like a visionary genius when every ticker on your screen is flashing bright green and your net worth is expanding faster than your ability to comprehend it, yet this is precisely when the Greek myth of Icarus becomes most relevant to your survival. The heat of market euphoria can melt the wax of your discipline just as easily as the sun destroyed the wings of the boy who flew too high, proving that the greatest threat to your wealth is no longer the market itself, but the person you see in the mirror every single morning. The ultimate trap waiting at the peak is not a market crash, but the subtle and seductive onset of lifestyle inflation, where you begin to trade your future freedom for temporary symbols of status that lose value the moment you drive them off the lot. When you look back at that initial feeling of standing on a skyscraper with no railing, you must realize that the real danger was never the height of the market, but the temptation to jump into a sea of debt and luxury consumption that anchors you to a job you no longer love. If you take the harvest of this record-breaking market and use it to buy more liabilities rather than more productive assets, you are essentially throwing away the keys to the kingdom just as you are about to unlock the door to permanent autonomy. The record highs we see today are merely the current chapters in a long and complex story of human progress and American economic resilience that will continue long after the current news cycle has faded into obscurity. Your goal is not to win a sprint against the market, but to finish the marathon of wealth accumulation with your character and your capital fully intact, regardless of the inevitable storms that will eventually follow this period of sunshine. Stay focused on the system we have built together, keep your eyes on the long-term horizon, and remember that the most successful architects of wealth are those who remained disciplined when others were greedy and stayed calm when the rest of the world was consumed by either terror or triumph. Success in the stock market is rarely about being the smartest person in the room, but about being the most disciplined person in the room. As the markets continue to reach for the stars, let your strategy be your gravity and your long-term vision be your compass. The heights are only dangerous for those who have no plan for the descent or the next climb.